Imagine we have a group where M&O Limited is the parent company, and it has two subsidiaries, ABC Limited and XYZ Limited. In this scenario, we have two different audit firms involved. SS Maheshwari and Company is the auditor for the parent company, M&O Limited, while RT and Associates handles the audits for both subsidiaries. Now, here is the key part. SS Maheshwari and Company will act as the principal auditor. This means they carry the ultimate reporting responsibility for the consolidated financial statements of the entire group.
First, the management of each individual company, the parent and both subsidiaries, is responsible for preparing their own standalone financial statements. These are then audited by their respective auditors. Once those standalone accounts are ready, the parent company, M&O Limited, prepares the consolidated financial statements for the whole group. Finally, the principal auditor steps in to audit these consolidated statements.
As a CA Final student, when you approach this topic, there are 5 critical areas you need to focus on. First, understand the responsibility of the parent company in the consolidation process. Second, look at how permanent and current period consolidation adjustments are handled. Third, focus on the specific procedures the principal auditor must perform. Fourth, pay close attention to the coordination and division of responsibility between the principal auditor and the subsidiary auditors. And fifth, understand the final reporting requirements.
Regarding the presentation, remember that consolidated financial statements should generally follow the same format as the parent company's separate financial statements. In India, these formats for the balance sheet, profit and loss account, and the statement of change in equity are strictly prescribed under Schedule 3 of the Companies Act 2013. Depending on the law or the entity's own requirements, they will engage an auditor for the consolidated accounts. Often, the law requires that the statutory auditor of the parent company, the one auditing the standalone statements, also be the one to audit the consolidated statements.
To wrap this up, keep in mind that according to the guidance note, the audit of consolidated financial statements isn't just about the balance sheet. It encompasses the consolidated statement of profit and loss, the consolidated cash flow statement, the statement of change in equity, if applicable, and all the accompanying explanatory notes. Keep these components in mind, and you'll have a solid grasp of the scope of a group audit.
Now, let's dive into the world of group audits. When we talk about auditing consolidated financial statements, the primary roadmap we follow is Guidance Note 13.5. It is important to understand that this guidance note focuses specifically on the audit procedures and the issues an auditor faces during a group audit. It doesn't teach us how to do the accounting for consolidation. Instead, it tells us how to audit it. For the actual accounting rules, we look to Accounting Standard 21 or Indian Accounting Standard 110, depending on which framework the company is following.
Now you might be wondering, is consolidation always mandatory? Under the Companies Act 2013, specifically Section 129, the answer is a resounding yes. If a company has one or more subsidiaries, associates, or joint ventures, it must prepare consolidated financial statements in addition to its own standalone statements.
The law is very clear here. The same rules that apply to the preparation, adoption, and audit of a holding company's own financial statements apply, mutatis mutandis, to its consolidated statements as well. This means the board of directors must approve the consolidated statements before they are signed, and these must be presented at the annual general meeting alongside the standalone accounts. To keep things transparent, the company must also attach Form AOC-1, which highlights the salient features of the subsidiary's financial statements. Finally, remember that the consolidation must align with Schedule Roman 3 of the Companies Act and the applicable accounting standards. Even if a company isn't required to prepare consolidated statements under the accounting standards, it must still comply with the provisions laid out in Schedule Roman 3.
Now, let's dive into the specific exemptions regarding the preparation of consolidated financial statements. As you know, the general rule is that if a company has subsidiaries, it must consolidate. However, there are 3 critical conditions that, if met simultaneously, allow a company to skip this requirement.
First, the company must be a wholly owned or partially owned subsidiary of another company. If it's partially owned, all other members, including those without voting rights, must be informed in writing, and the company must have proof that they received this notice and did not object to the absence of consolidated statements.
Second, the company's securities must not be listed, and they shouldn't even be in the process of listing on any stock exchange, whether here in India or abroad. And third, the ultimate or any intermediate holding company must already be filing consolidated financial statements with the registrar that comply with the applicable accounting standards.
It is also important to note that under Section 129, subsection 6 of the Companies Act, 2013, the central government holds the power to exempt certain classes of companies from these requirements if it's deemed necessary in the public interest. This exemption can be unconditional or tied to specific conditions. The core objective here is transparency. By requiring companies that previously ignored consolidation to now adhere to these rules, stakeholders get a much clearer picture of the entire business group's health.
Finally, let's look at the investment entity exception. An investment entity doesn't need to present consolidated financial statements if, under IND as 110, it measures all its subsidiaries at fair value through profit or loss.
How do we identify an investment entity? It must meet 3 criteria. It obtains funds to provide investment management services. It commits to investors that its sole purpose is to earn returns from capital appreciation or investment income, and it evaluates the performance of almost all its investments based on fair value. Keep these distinctions clear, as they are vital for your exams.
Now, let's dive into a critical area of group audits, specifically focusing on the consolidation of financial statements under IND as 110.
First, let's clarify a key rule regarding investment entities. According to paragraph 33 of IND as 110, if a parent company controls other entities even through an investment entity subsidiary, it must consolidate all of them. The only exception here is if the parent company itself is an investment entity. If the parent isn't an investment entity, consolidation is mandatory.
To make this crystal clear, let's look at a practical case study. Imagine a company called Parent Limited. They acquired 51% of the shares of Child Limited during the year ending March 31, 2023. Then, in the following year, they sold 20% of those shares. Now, here is the problem. Parent Limited completely ignored Child Ltd's financial statements when preparing their own consolidated reports for both 2023 and 2024. As a statutory auditor, how do you handle this?
You need to be firm here. Under IND as 110, there is absolutely no such thing as an exemption for temporary control. Some companies might argue that they only held the shares for a short time or that there were severe long-term funds transfer restrictions, but IND as does not recognize these as valid reasons to avoid consolidation.
Now, you might wonder about the Companies Act, 2013. Section 129, subsection 3, does mention that if a company isn't required to prepare consolidated statements under the applicable accounting standards, it can simply comply with the provisions of Schedule Roman III. However, in this specific case, since the company is following IND as, the IND as rules take precedence. Paragraph 20 of IND as 110 is very explicit. Consolidation must begin the moment the investor obtains control and must only cease when that control is lost.
Conclusion is straightforward. Parent Ltd's intention was clearly to treat this as a temporary investment, but that doesn't change the accounting requirement. Since Parent Limited held 51% and then 31%, they maintained control throughout both years. Therefore, they were required to prepare consolidated financial statements for both periods. Finally, remember that the ultimate responsibility for the preparation and presentation of these consolidated financial statements rests squarely with the management of the parent company.
First, the parent company needs to identify all the components, meaning the subsidiaries and associates, and determine exactly which financial information needs to be pulled in. This isn't just about the balance sheet. It involves identifying reportable segments for segmental reporting and pinpointing all related party transactions to ensure full transparency.
But it doesn't stop there. The parent must ensure they are getting accurate and complete data from these components. They then have to make the necessary consolidation adjustments like eliminating intercompany transactions and ensure there is a total harmonization of accounting policies. If the subsidiary uses a different accounting framework, the parent must perform a GAAP conversion so that everything speaks the same financial language.
To make this happen, the parent company typically issues a set of formal instructions to the management of each component. These instructions act as a guidebook, specifying the accounting policies to be used, the disclosure requirements, and a strict reporting timetable to ensure everything is submitted on time.
Now, let's shift our focus to the responsibility of the auditor. Under Section 129, subsection 4 of the Companies Act 2013, the rules for preparing and auditing the financial statements of a holding company apply, with necessary modifications to the consolidated financial statements as well. You are also required to report on any additional matters mandated by the Companies Act or other relevant statutes.
As the principal auditor, your primary responsibility is to express an opinion on whether these consolidated statements are prepared, in all material respects, according to the applicable financial reporting framework. Ultimately, your core objective is simple but vital. You must satisfy yourself that the consolidated financial statements have been prepared in strict accordance with the requirements of the applicable financial reporting framework.
Now, let's dive into the core objectives and considerations for group audits. When we talk about auditing consolidated financial statements, or CFS, the auditor's primary goal is to express an opinion on whether these statements present a true and fair view. But it's not just about the final opinion. The auditor has specific statutory responsibilities under the Companies Act 2013. This includes inquiring into the matters specified in Section 143(1) and reporting on the various requirements of Section 143(3). You'll also need to comment on specific matters under Rule 11 of the Company's Audit and Auditor's Rules 2014, wherever they are applicable. One very important step here is for the auditor to validate whether the company is actually required to prepare consolidated financial statements based on the financial reporting framework they are following.
Now, a common question students ask is, do the standard auditing rules change for group audits? The answer is no. The standards on auditing, statements, and guidance notes issued by the ICI apply to consolidated financial statements in the exact same way they apply to standalone statements.
This means that as an auditor, you are expected to do three key things. First, plan your work carefully to ensure the audit is effective, efficient, and completed on time. Second, you must gain a deep understanding of the accounting and internal control systems. This includes looking at the IT systems, such as the consolidation tools used to merge the data. This understanding is what allows you to develop a solid audit approach. And third, you must use your professional judgment to assess audit risks and design procedures that bring those risks down to an acceptable level.
To wrap this up, let's look at the audit considerations. The most critical feature to remember is that consolidated financial statements aren't created from scratch. They are built using the separate financial statements of the parent company and its components. These are then merged using the consolidation procedures prescribed by the relevant accounting standards, such as S21, S23, and S27. Because of this structure, the group auditor generally forms their opinion on the components based on the reports provided by the auditors of those individual components.
Now, let's dive into a very critical area of advanced auditing, the audit of consolidated financial statements. When you are auditing a group, you're dealing with the parent company and its various components, like subsidiaries. The first thing you need to understand is the role of the auditor. If you are the auditor of the consolidated financial statements, you have a choice. If you aren't already the auditor for every single component in the group, you can leverage the work of other auditors as per the standards on auditing.
But here is where it gets interesting. Consolidated financial statements aren't just a simple addition of separate financial statements. They are built using the separate statements of the parent and its components, plus something called other financial information. You might wonder, what exactly is this other financial information? Think of it as the glue and the adjustments that make the consolidation work. This includes specific disclosures about the components, identifying areas where different accounting policies were used, and most importantly, the adjustments made for significant transactions that happened between the parent and its subsidiaries.
As a professional auditor, before you even start, you must perform a self-assessment. Ask yourself, based on my own work alone, can I express a true and fair opinion on these consolidated statements? If the answer is no, perhaps because the group is too large or the components are in different geographical locations, and you should consider using the work of other auditors to bridge that gap.
Make this crystal clear, let's look at a practical example of consolidation. Imagine a group where entity A is the parent, and B and C are its subsidiaries. If B has a loan with A, that's an intercompany transaction. In the separate books, A shows a receivable and B shows a debt. But in the consolidated view, these cancel each other out. We call these eliminations. For instance, the shares A holds in B and C are eliminated against the equity of the subsidiaries so that we don't double count the value.
Finally, keep in mind the regulatory framework. You'll be relying heavily on IND as 110 for the actual consolidation process, IND as 111 for joint arrangements, IND as 112 for disclosures, and IND as 28 for associates and joint ventures. Also, a quick tip on terminology. Keep an eye out for intermediate consolidated financial statements. This happens when you have a chain of ownership. For example, if Company A owns Company B and Company B owns Company C, then Company B is an intermediate parent.
Now, let's dive into the concept of group audits, which is a critical area for your CA final exams. When we talk about consolidated financial statements, we encounter the principal auditor, that's the auditor reporting on the group as a whole. Often, the principal auditor needs help from other auditors. These other auditors could be the statutory auditors of a specific component, or they could be specialists appointed specifically to assist with the consolidation process. Here is a very important distinction you need to remember. If a statutory auditor of a component is asked to help the principal auditor, that work is treated as a completely separate assignment from their regular statutory audit of that component.
To handle this process, we follow Standard on Auditing 600, which is titled Using the Work of Another Auditor. If the principal auditor decides to rely on the work of another auditor for the consolidated statements, SA 600 is the guiding light.
Now, let's talk about materiality, because this is where most students get confused. First, remember that for the standalone financial statements of each component, materiality is calculated on a standalone basis. But when we shift our focus to the consolidated financial statements, the approach changes. The principal auditor must first compute materiality for the group as a whole. This group-level materiality is used to check if the consolidation adjustments made by management, both permanent and current period adjustments, are appropriate.
Furthermore, the principal auditor uses this group materiality to decide if a particular component is material to the group. This helps them decide which components to scope in and whether they need to engage other auditors. Additionally, the principal auditor will compute a specific materiality for each component and communicate this to the component auditor to ensure the consolidated financial statements provide a true and fair view.
Finally, the principal auditor doesn't just take the numbers. They must obtain specific confirmations from the component auditors regarding their independence and adherence to the Code of Ethics, as well as the necessary information for disclosures. And a quick tip: if the component auditor has issued a modified opinion or an emphasis of matter in their standalone report, the principal auditor must apply the principles of SA 600 to decide how that affects the group audit report.
First, let's talk about how the parent auditor handles the reports from component auditors. If a component auditor has included a modification, an emphasis of matter, or an other matter paragraph in their stand-alone report, the parent auditor can't just ignore it. They must follow the requirements of Standard on Auditing 600, which deals with using the work of another auditor. The key takeaway here is that the parent auditor must apply the concept of materiality. They need to evaluate whether the issue raised by the component auditor is significant enough to impact the consolidated financial statements as a whole.
Moving on to the actual process of auditing the consolidation. Before you even start, planning is everything. To ensure the audit is effective and timely, you need a solid roadmap. This involves 5 key areas.
First, you must understand the group structure and the group-wide controls. This includes a deep dive into the IT systems, looking at both the general and application controls, whether they are manual or automated, that drive the consolidation process. Second, you need to get a clear grip on the accounting policies. You must ensure the parent and all its components are aligned, and you need to understand exactly how the consolidation process works, especially when it comes to translating the financial statements of foreign components into the reporting currency.
Third, you'll need to program your audit procedures. This means determining the nature, timing, and extent of your work based on where you see the highest risk of material misstatement within the consolidation process. Fourth, you must decide to what extent you will rely on the work performed by other auditors. And finally, you need to coordinate all these moving parts to ensure the audit flows smoothly.
One last crucial point: a parent company is required to consolidate all its components unless a specific exception is provided in the accounting standards. As an auditor, your job is to obtain a complete list of all components from management and verify that every single one has been included. If any are missing, you must verify that they strictly meet the criteria for exclusion. Keep this rigor in mind, and you'll handle the consolidation audit with confidence.